allow me just to delve straight into the agenda of the day, where I'll be presenting our results. The bank has witnessed tremendous growth in all parameters, as you will witness in the numbers that I'm about to announce. So the first number I'm announcing is our customer deposits. Our customer deposits have grown by 25.8%, approximately 26%, to 60.2 billion, compared to 2018 similar period, where we had deposits of 47.89. So this has been supported by aggressive deposit mobilization from our institutional partners, personal and transaction accounts. Our loan book has grown to 49.3 billion, when compared to 44.5 billion similar period last year. And again, this has been attributed to aggressive lending to the micro and SME space, despite what we would have expected otherwise with the interest cap. The next number is our liquidity ratio. This has maintained well above 30%, which is above the statutory limit of 20%, which is contained in, which is the CBK requirement. So we are quite pleased with this position, and this liquidity is what has been able to see us increase our lending. The next number is our operating income. You'll notice that our operating income grew by 14% compared to the same period last year. This is attributable to three factors. The first one is the net interest margin, which grew by approximately 16.7%. And then you've got a non-interest income, which grew by 10.6% to 2.1 billion. This was driven mainly by foreign exchange trading income and other fees and commissions. So, and the next one that I unveil is that there was an overall reduction in our operating expenses. This maintained at the same level despite an increased volume and scale in business. The cost containment measures that we embarked on in 2017 and our aggressive investment in digital innovation and deposit mobilization has seen this cost, our operating expenses, hold at the same rate as last year despite the increased volume and scale of business. It's against these parameters that we've seen our PBT grow by 274% to a figure of 1.1 billion and 8 million, against a figure of the same period, 270 million. So for us, this is a tremendous growth, which is a growth of around 738 million growth in profitability. Obviously, this has been driven by the parameters I've said, the increased lending, the growth in customer deposits, and also aggressive collections, which have seen also a decline in our NPL number. So, ladies and gentlemen, what has seen us sustain this growth throughout the year? First is the adoption of digital channels. The bank has really moved to invest highly and revamp our mobile application, including especially PesaPap. To date, our PesaPap has 200,000 customers, and this year alone we've issued 1.5 billion in digital loans to over 120,000 borrowers since we launched the PesaPap loans in July 2018. We're also happy to note that we've increased the number of transactions on our digital platforms, and these stand at 70% of our total transactions. The bank also has been quite innovative. In 2018, we started an instant money transfer from Kenya to China and India in partnership with SimbaPay. And this is Family Bank Remit, which is available on the mobile application called PesaPap, and is available to both Family Bank and non-Family Bank customers, and enables them to transfer money easily to those countries. This is because we recognize that those are the major trading partners for most of our customers in Kenya, and we've seen them benefit from that space. The other thing we did in the innovation space, we were the first to launch salary advance on mobile and ATM, and this is available on our mobile channel. So this has seen us revamp our consumer banking proposition with that salary advance proposition. Our salaried customers can now access 50% of their monthly net salary top up on existing, and also can top up on any existing salary advance. We have been aggressively investing in digital solutions to drive convenience to our customers as the industry makes a move towards financial technology to supplement the usual brick and mortar banking. Secondly, what we've embarked on and what our profitability is attributable to, as I mentioned, was our aggressive deposit mobilization strategy. These targeted institutions, county governments, corporates, NGOs, SME customers, SACCOs, and individuals. We are happy to note that our deposits are spread from institutional deposits to current account deposits. With consistent customer engagements through the country, we've seen confidence rebuilding in the bank, which has been seen as grow our deposits by over 24% from 2018 to date. Lastly, but not, since, as I mentioned, 2017, we've undertaken a lot of branch rationalization and cost containment measures. These have included the migration of transactions to digital financial services, and this has reduced traffic to our branches. It's also seen as optimize our physical presence and resource reallocation that has seen us merge and move some of our branch operations. Again, with this cost containment, the bank has been able to drive efficiencies and grow its income. Last but most importantly, all this has been made possible by a re-energized and dedicated staff of Family Bank, spread across our 90 branches from Busia to Malindi, who are really, really committed to taking this institution to the next level. Ladies and gentlemen, this would not have been possible without our shareholders and our over 600,000 customers who have stood with this bank through our toughest time and believed in us and the values that we stand for. I would like to express my gratitude to each and every one of them. Some of them are represented in the house today. We can see our shareholders across the room, our institutional partners, our customers, and the staff of Family Bank here today. Indeed, we say thank you very much and assure you that the bank has what it takes with your continued support to propel itself to the next level. We are confident that moving forward, we have the solid strategy in place that will enable us ensure that our customers attain excellent customer experience, and will continue to adopt transformative technology in our service delivery and equip our teams to better support our strategy. The future can only be bright at Family Bank, and we hope that you will journey with us as we make this bank great again. Thank you very much. God bless you, and God bless Family Bank. Thank you very much.
I think after Rebecca's presentation, I don't really have very much to add, because I think the story for Family Bank and the transformation that has taken place in the last 12 months, or the last 2 years for that matter, is quite evident from the figures that you have seen there. And we are very, very proud about the success that we have seen. So it is my great pleasure, actually, and joy to stand here and to be part of that great story. Because, you know, when you saw that figure, that graph there, which on the left-hand side was showing some red, huge red, and now crossing the line and going to the other side and looking up, I think that really says what has happened in Family Bank in the last 2 years. And I'm very happy and proud to be part of that journey. But our journey has not been easy, okay? Our journey has not been easy. To record the kind of figures that we've talked about here, where year-on-year growth, we have recorded a growth of 274% from this time last year. I don't think there are many institutions in Kenya that will be recording that kind of growth, albeit from a small base. But nevertheless, a success is a success, and I think we have every right to be proud of. To our shareholders who are here, I know you have had a very difficult time. In fact, in 2016, 2017, when the financial sector was going through some very tough headwinds, people were worried about their investment because they didn't know whether Family Bank was going to survive that turbulence. But I want to thank my board and also the management because they really came out very, very strongly to save the bank. And I think the results are there for themselves. So we are very proud about that. I think for shareholders, what I would like to say, we really appreciate your patience. I know we have not paid you any dividends for the last 3 years, but I think at that particular point in time, it was more important to save the institution than to pay the dividend. In any case, we could only have paid the dividends from the equity, and that is never allowed, not even under the law. So I want to tell the shareholders that thank you for your patience. We need just a little bit more time, and we'll be back in business in terms of just how we go forward, because the kind of figures that we are looking around is very promising. I also want to say that for the institutional investors, after the 2016, the debacle of some of the local banks that actually hit some headwinds and collapsed, understandably, some of the institutional investors were wary about investing in tier 2 banks, and I think rightfully so, because they weren't sure what was happening. And we saw a lot of flights of deposit to safety. A lot of deposits moved from tier 2 banks, tier 3 banks to tier 1 bank. And I think because they were not sure which bank was going to be next. I want to really assure them today that they should consider doing business with us on a regular basis, because I think the story of Family Bank is very, very clear. We found out exactly what the problem was, and we fixed it. One of the most important things that a lesson that we learned during that time was the issue of compliance with the regulator and with the things that are there that are needed. We looked at the issues of governance, and those we have fixed. We also looked at the issues of investment in the technology that helps us to be able to remain compliant at all times, and also to be able to manage our loan book. In today's papers, our results have been published, and you'll find that our non-performing loan portfolio is still higher than it needs to be. And I think that's a historical fact. But what I want to say, despite the big number that you see in the non-performing loans, what I want to say is that the book that we have lent in the last 2 years is performing, in fact, better than the industry average, because the non-performing loans that we have done in the last 2 years is trading at around 4% NPL. So, and you know the industry average is around 12%. So we are very happy about that. I think we have fixed our credit monitoring and our credit administration, and we are doing very well. But the historical non-performing loans that we have are still with us, and it will take a little bit of time. We are focusing on collecting that because it's about 8 billion shillings. It's a lot of money, but we are focusing on that to ensure that, in fact, we collect it. Part of the problems that we have found, particularly in our inability to collect this debt, a lot of it has to do with the fact that some of the customers that we have, particularly the contractors and suppliers, and especially those who are doing business with the governments, have not been paid. And I would like to really appeal to the government that the government is supposed to be a facilitator of business, not an impediment to the business. And the government really needs to get their act together to pay the suppliers and the contractors who do work for them, so that in turn they can also be able to pay their loans. Because a lot of people, and like now, if you look at the Business Daily, not the Business Daily, the Daily Nation on Tuesdays, we are having up to 8 pages of advertising for auctioneers. And I must say that it is not in the business of banks to give business to auctioneers. But we are in this sorry state because of people who owe other people and not meeting their financial obligations to pay. And therefore, I really want to appeal to our government to do whatever it is they can do to ensure that they pay the contractors, they pay the suppliers, so in turn, they can be able to service their loans. And I hope this will happen. We welcome the initiative that the Parliament is taking to try to have a legislation around how government does business with the ordinary Kenyans. And so that, in fact, so that you know when you do business with the government, you can get paid in time. We really welcome that, and we hope that the spirit of that law will be adhered to, and then people can do business with the government in a confident manner. So I don't want to take a lot of your time, but I say that a lot of other things that have happened, and maybe I should just touch a little bit. I want also to appreciate the lifting of the interest rate caps by the government. And as you know, this has been a huge debate as to saying, and it was very interesting looking at the people in the Fourth Estate, where they said, now the era of high interest rates has come back. I don't think it has come back. Personally, I don't think it has come back. I think any bank that thinks that by taxing or putting in very high interest rates to their customers is the way to go, I think that's a very short-sighted manner of looking at it. Banks thrive when it works for their customers, and because if it works for their customers, it also works for them. We at Family Bank are not going to be in any hurry to review our rates. I think what has just happened through the lifting of that cap is to just give the flexibility to the banks to be able to negotiate a rate that works for both of them. But I am not seeing where the interest rate then shoot up to 20-30% where they used to be before. There will be some adjustment, but not much. As Family Bank, currently, we are not thinking of reviewing that rate for now, but we just have to see how the things go, because what drives us most is to say, when we are talking with our customer, what works for him? What works for him? On the same breath, I think also the other people who will also determine which direction the rates are going to go are the guys who are sitting with funds, the guys who are very liquid, and I think some of them are sitting here because yes, when you have liquid cash, you want to get some return on that investment because it's your money, and the money you cannot just keep it. It's not earning you anything. So it depends very much on how the movement of the deposits, because of course when the deposits go up, the cost of money also goes up, and therefore when you're on lending to the customers, that also has to be taken into account. So let's see how all these moves out. But I think the bottom line is to say that things work out for everybody when the economy is growing. And from where I sit, I think we have a lot of contradictions of figures that I can't reconcile myself. When we hear our GDP is growing at 5.9%, 6%, but when you look at the ground, when I look at the people, the customers that we are dealing with, you don't get that impression at all. You talk with the customers and they tell you they are hurting. You talk with the customer and they tell you, whether it is the guys who are selling mitumbas, whether they are the farmers, whether they are manufacturers, wherever they are not seeing that GDP growth. So I think we need, maybe I'm not an economist, but I think we need economists to tell us where is this GDP, because the average person, if you see them, when you see somebody walking with tattered clothes, then you know things are not very well. And I think that's what we are seeing in our economy today. So for Family Bank, we want to be part of the journey to transform this economy. Our focus is not on the big corporates, although we don't shun them. We think that we'll have bigger impact looking at the SMEs and MSMEs, because this is where most of the Kenyans live. This is where most of the Kenyans who make an impact and who create jobs are. And therefore, our strategy is actually to focus on that area within the SME space and the MSME space, because even the big corporates, at some point, they were SMEs before they became corporates, and we think that is the focus we should be on. In conclusion, I want to say this. Our long-term objective is to become a Tier 1 bank. Yeah? We got derailed. If before the headwinds hit us in 2017, we were on a very clear path of becoming a Tier 1 bank. But then I think there was one old mzee called Paul Gay who said once that sleeping is not falling. And therefore for Family Bank, we slept, but we didn't fall. We woke up, we dusted ourselves, and we are moving on. So that dream of becoming a Tier 1 bank remains very real. We still want to do it, and we are very focused and very clear that we will become a Tier 1 bank. And we can only do that with the help of our institutional investors, us, the customers, the commitment and the audacity of our staff.